Understanding investment returns. A beginner's guide. Hello, everyone. Welcome to our English language learning series. Today, we're going to explore a very important financial term, investment returns. Understanding this concept is not just crucial for finance professionals but also for anyone who wants to make informed decisions about their money. So, let's dive in and unravel the meaning of investment returns together. Investment returns refer to the money gained or lost on an investment. This includes income earned, such as interest or dividends, as well as any change in the value of the investment. It's important to understand that returns can be positive or negative, depending on whether the value of the investment goes up or down. There are two main types of investment returns. 1. Capital gains. This occurs when you sell an investment for more than you paid for it. For example, buying a stock at $100 and selling it later for $150 gives you a capital gain of $50. 2. Income returns. These are earnings from interest or dividends. For instance, if a bond pays you $10 interest annually, that's your income return. Both capital gains and income returns contribute to the overall performance of your investment. Calculating returns can be simple or complex, depending on the investment. A basic formula is return percent equals current value, original value times 100. This formula helps you understand how much your investment has grown or shrunk percentage-wise. It's crucial to understand the relationship between risk and return. Generally, higher returns come with higher risk. This means that investments with the potential for high returns, like stocks, also come with a greater chance of losing value. On the other hand, safer investments like government bonds typically offer lower returns. Let's look at some examples. 1. Stocks. If you buy a stock and its price increases, your capital gains increase. Plus, if the company pays dividends, you get income returns. 2. Bonds. When you buy a bond, the income return is the interest paid by the bond issuer. 3. Real estate. Investing in property can provide returns through rental income, income returns, and property value appreciation, capital gains. Understanding investment returns is a key part of financial literacy. Whether you're investing in stocks, bonds, or real estate, knowing how returns work helps you make smarter decisions with your money. We hope this video has shed some light on this important topic. Stay tuned for more insightful videos, and happy investing!